Walk into any car showroom today and you'll see the boldest signs promising you a new vehicle for $0 down. मैं रोजाना कई लोन फाइल्स देखता हूँ और लोग अक्सर जीरो डाउन पेमेंट के चक्कर में अपना नुकसान कर बैठते हैं. As an insider, I see these files daily, and borrowers consistently sabotage their own finances chasing this illusion. A zero down payment loan occurs when a bank finances exactly 100% of a vehicle's on-road price. The borrower pays nothing for the vehicle itself at the dealership, covering only the immediate file charges and processing fees. In banking, this is known as 100% LTV, or loan to value. Loan to value is a financial ratio that compares the amount of a loan you borrow against the total market value of the asset you are buying. Zero down is simply a marketing label for an incredibly aggressive financial product. This high-risk credit facility mathematically penalizes the borrower for lacking initial capital. To see the penalty, we have to pull back from the dealership floor and view the application through the eyes of a bank underwriter. When a borrower requests every rupee of the car's price, the bank's ledger records a maximum risk scenario. A standard 80% LTV file rests on a stable base of borrower equity, while the zero-down 100% LTV file is entirely filled with debt. To approve that debt, the underwriter must determine who qualifies, identify the hidden costs in the contract, and calculate the impact on the borrower's monthly cash flow. Failing to account for these three metrics leads to severe long-term financial strain. Beating the system requires deconstructing the exact mathematics the bank uses to evaluate your application. Underwriters look for a margin of safety, which is a financial cushion that protects a lender against losses if a borrower defaults. Without a down payment, the bank has no cushion if you stop paying tomorrow. Banks deploy aggressive gatekeeping to offset this missing safety margin. This loan is strictly restricted. The first 8 is creditworthiness, requiring a CIBIL score comfortably above 750. CIBIL is a numeric summary of a person's credit history, used by lenders to gauge their ability to repay debt. The second gate is cash flow verification. The bank requires proof of income through stable salary slips or a healthy business profit and loss statement. High income in a single month is not enough. The underwriter verifies that this cash flow is consistent over time. The third gate is historical reliability. The bank looks for a flawless banking history, with no missed or delayed EMI payments on previous loans. Past behavior serves as the bank's only predictive model for how you will handle a maximum risk 100% LTV obligation. Passing these gates simply means the bank considers your cash flow reliable enough to take a systemic gamble on your application. Bank risk spikes the moment you drive that fully financed car off the lot. You are now holding an underwater asset. An underwater asset is a situation where the outstanding balance of a loan is higher than the current market value of the asset.
On this graph, the car's asset value plunges downward immediately, while the loan principal decays very slowly. That red shaded gap is the bank's risk zone. It is unsecured debt that the bank cannot recover even if they repossess the car tomorrow. The bank addresses this unsecured risk by charging a mathematical penalty. A zero-down loan typically carries an interest rate 1 to 2% higher than a standard auto loan. This hidden premium compounds over a 5 to 7-year tenure, significantly inflating the total cost of the vehicle. Borrowers absorb the entirety of the bank's risk through these elevated, unrecoverable interest payments. The mathematical penalty moves from the bank's ledger directly into your monthly household budget. This impacts your debt-to-income, or DTI ratio. The DTI ratio is a personal finance measure that compares an individual's monthly debt payments to their monthly gross income. A zero-down loan creates a double whammy. You borrow the maximum possible principal while paying the highest possible interest rate. This results in a bloated EMI, or equated monthly installment, which takes a disproportionately large slice of your monthly income. This reduces your operational budget, leaving less capital available for emergencies, investments, or basic living expenses. This cash flow restriction locks you into a high-stress financial position for the next half-decade. The cost of paying zero upfront is the systemic reduction of your monthly financial freedom. As a finance professional, my recommendation for structuring a vehicle purchase is clear. If you have liquid capital, deploy a 10 to 20% equity buffer as a down payment. An equity buffer is the cash difference between the car's market value and the remaining loan balance, serving as a cushion for the borrower. This chart shows the immediate mathematical return on investment of that down payment. This action bypasses the bank's risk premium, allowing you to access standard, lower interest rates. It also shrinks the principal balance, which permanently lowers your monthly EMI payments. Do not take a 100% loan purely for the status of acquiring a vehicle immediately. Use cash to absorb the depreciation shock, forcing the bank to offer their most affordable capital. The zero-down vehicle loan is a mathematical trap designed to capitalize on consumer impatience. While it appears attractive in marketing, banks always ensure they are compensated for the additional risk. Always prioritize the mathematics on the ledger over the shine on the showroom floor. Prioritizing the ledger's mathematics over the showroom's aesthetic establishes a foundation of financial stability and long-term intelligent momentum for your capital. If this breakdown was helpful, please like the video and share it with friends who are planning a vehicle purchase. Ask any specific questions about loans or CIBIL requirements in the comments, and subscribe for more rigorous finance deconstructions. Thank you.